So if you look at the financial landscape today, this specific Tuesday, August 18th, 2026, you are essentially watching this massive multi-lane highway operating in two completely different realities.
It is a totally bifurcated economy right now.
Yeah.
Because in one lane, you have the traditional consumer economy, the world of buying houses, hiring workers, physical goods, and that lane is locked in bumper-to-bumper gridlock. The engines are running, but nobody is actually moving.
But then you glance over at the passing lane and the artificial intelligence sector, alternative capital, and even some highly specific commodity markets. They are just flying by at blistering speeds.
Which creates a market defined by heavy friction in the physical world and this near infinite liquidity in the digital space. Our mission today is to uncover the connective tissue between those two extremes.
We are going to trace the line from a totally frozen housing market and surging U.S. bond yields straight through to a $105 billion banking pivot by an AI hardware giant, and somehow end up explaining a sudden 70% price spike in British wool.
We really have to start in that gridlocked lane, though, specifically with what feels like this great hesitation happening across the corporate world right now. Just look at Home Depot. They reported their second quarter earnings for the period ending August 2, and on paper, it looks like a solid win.
Right, because revenue is up 5.7% to nearly $48 billion. And same-store sales, which, measures revenue from stores open for at least a year to strip out the artificial boost from just opening new locations, that grew 1.7%.
But underneath those headline numbers, the reality is much colder. Their chief financial officer explicitly described the environment as frozen housing market conditions.
Yeah.
Everyday consumers are simply terrified of taking on massive do-it-yourself home renovations right now.
So corporate survival tactics are masking that underlying freeze. Since regular homeowners are delaying those large-scale projects, Home Depot is shifting its entire operational weight toward professional contractors who still have this backlog of essential maintenance work.
Exactly, and their profit margins also received this massive one-time artificial inflation from a $685 million tariff refund. That capital flowed back onto their balance sheet after a Supreme Court ruling earlier this year struck down a specific set of import duties.
Take away that refund and that aggressive pivot to pro-contractors, and the stagnation in everyday consumer spending becomes glaringly obvious. It's actually funny, looking at Home Depot and other massive corporations right now, they've essentially turned into winter foragers.
Winter foragers, that is actually a perfect way to describe it.
They used to hunt big game, right? The massive new home builds, the explosive headcount growth. But now that the economic winter is set in, they are out in the woods surviving by picking nuts and berries, just scraping by on professional maintenance and hyper-efficiency.
And that hesitation is echoing heavily across global labor and industrial markets, too. In the UK, official job vacancies just hit a 5-year low, dropping to 707,000. Small businesses are simply refusing to hire.
The primary catalysts there are soaring energy costs, which, have been climbing ever since the Iran war began in late February, and that is compounded by higher minimum wages and increased national insurance burdens.
You can see the physical manifestation of that labor freeze in places like Scotland's Ferguson marine shipyard. This is the last commercial shipyard operating on the River Clyde, and they are currently cutting nearly a quarter of their workforce, which is about 70 positions.
They are just starving for work, waiting on delayed government orders for smaller ships. Because when the cost of operating an industrial business becomes mathematically unpredictable, companies immediately sever their most expensive variable, which is human labor.
Discretionary spending on leisure is catching that exact same headwind. Brunswick Corporation, which is the massive manufacturer of Sea Ray boats, is watching demand for their entry-level value boats completely evaporate.
Because those are the exact models that require middle-class buyers to secure financing. So to hit their 2030 revenue targets, Brunswick is practically abandoning its reliance on one-off physical sales.
They are pushing incredibly hard into recurring revenue streams. They're selling AI navigation systems and expanding their subscription-based Freedom Boat Club, which actually recently tripled its membership. The consumer is rejecting the heavy capital purchase of a boat, but they will happily rent fractional access to one.
Companies are even exerting bizarre control over their physical environments just to manage the mood and keep costs predictable. Like the UK pub chain Wetherspoons, they just enacted a strict ban on customers playing music or taking calls on phone speakers.
They are marketing it as a digital detox across their nearly 800 pubs. But strategically, it is a behavioral economics play to control the customer experience and enforce a specific atmosphere without, deploying extra capital for renovations or entertainment.
But mathematically, I have to ask, how long can a giant corporation actually survive on foraging, like on subscriptions, repairs, and efficiency, before they genuinely need a consumer to buy a core product again?
That structural ceiling is the fundamental danger of a defensive strategy. Efficiency only pads the bottom line temporarily before top-line revenue stagnation catches up with you. Subscriptions and repairs act as a bridge, but if that bridge doesn't eventually lead to a revitalized consumer, the business model begins cannibalizing itself.
And the primary reason the consumer is refusing to make those purchases comes down to the underlying cost of money. The bond market has essentially become the ultimate dictator of this economy.
U.S. Treasury yields are surging right now. The 10-year is pushing toward 5%, which has anchored 30-year mortgages at around 6.75%. If you want to know why the traditional consumer is completely frozen, that yield curve is the mechanism.
The pressures driving those yields higher are really compounding from multiple directions. The baseline is this massive U.S. budget deficit, which is currently projected at $2.1 trillion for the fiscal year.
To fund that deficit, the government has to issue a mountain of new debt, which requires higher yields to attract buyers. And layered on top of that is a tsunami of corporate debt issuance. Tech companies are borrowing heavily to build out AI data centers.
So corporate bonds are directly competing with government treasuries for finite investor capital. And finally, inflation fears are lingering, largely because diesel prices have spiked 48% over the past year due to that ongoing geopolitical situation in the Middle East.
Meanwhile, the Federal Reserve is choosing to just stand on the sidelines while this happens. The new Fed chair, Kevin Warsh, is holding rates steady, effectively refusing to step in and bail out the bond market. He is forcing Main Street to absorb these higher borrowing costs.
And while we track how high these rates go and what it means for your portfolio, you can always find more financial candy, brain candy, and classic audiobooks over at clarenhoratio.com. But getting back to the macro picture, let's look at this whole board for a second. We've got massive deficits, lingering inflation, and politicians totally distracted by election cycles. Is it fair to say Washington isn't exactly exercising financial discipline right now?
The bond market is aggressively pricing in that exact lack of fiscal discipline. Historically, the bond market is the only entity large enough to force a government's hand. When yields approach 5%, the sheer cost of servicing the national debt begins crowding out other essential spending.
Which brings up this phrase you hear tossed around constantly on Wall Street, the bond vigilante. For anyone who isn't glued to a Bloomberg terminal, these are essentially investors who protest a government's reckless spending by heavily selling off bonds, which drives interest rates up until the government is forced to change its behavior.
Are you asking if these bond vigilantes are essentially acting as a shadow government right now, stepping in to discipline the system when politicians refuse to do it themselves?
Yes, exactly. Because they are delivering the punishment directly to the consumer via those 6.75% mortgages.
And that high cost of capital is now colliding with severe border and policy friction. As of tomorrow, Wednesday, August 19th, the United States is scheduled to slap 50% tariffs on roughly $20 billion worth of Canadian goods. That's converted from 28 billion Canadian dollars.
This tariff package targets a massive swath of goods. I mean, everything from hockey sticks to imported wine. Canadian Prime Minister Mark Carney and President Donald Trump have been locked in intense wire-to-wire negotiations trying to avert this deadline.
The uncertainty alone is causing cross-border businesses to freeze future orders. And the friction is spilling aggressively into corporate government relations as well. Disney's ABC network is actively suing the Federal Communications Commission right now.
The FCC initiated an early review of ABC's broadcast licenses, and Disney's legal argument frames this as a retaliatory campaign targeting their programming decisions.
These macroeconomic pressures are driving immediate behavioral shifts at the ballot box, too. Today's primary elections across Florida, Alaska, and Wyoming are totally dominated by voters reacting to these exact financial realities.
In Florida, the political debate is intensely focused on the energy costs associated with building massive new data centers, with voters terrified of utility bill spikes. In Alaska, candidates are battling over taxes and energy permitting. And in Wyoming, the legacy of cryptocurrency regulation has become a central campaign issue.
That structural ceiling on traditional businesses and the heavy friction in physical markets makes the contrast with the left lane of our economic highway almost unbelievable. While the traditional economy is starved for affordable capital, the artificial intelligence sector is experiencing an absolute geyser of money.
Just look at NVIDIA. They are fundamentally changing their business model from a hardware supplier to a massive infrastructure bank. The scale of their financial maneuvering is unprecedented.
NVIDIA just committed up to $105 billion to backstop a giant open AI data center campus in Ohio. They have the firepower to execute this because their free cash flow over the last 3 years jumped 18-fold, reaching $48.5 billion in the latest quarter alone.
They are taking that mountain of cash and financing the build-out of the AI ecosystem to ensure downstream demand for their chips never slows down. Their CEO successfully went to Wall Street and convinced major financial firms to treat NVIDIA graphics processing units as a brand new revenue-generating asset class.
They are pooling capital from private equity and asset managers to fund these data centers.
But it feels dangerously close to the historical company store model. I mean, is this a brilliant piece of vertical integration where a company takes control of multiple stages of its own ecosystem to maximize efficiency? Or is it a circular loop where NVIDIA is essentially lending billions of dollars to its own customers just to artificially prop up the demand for its own hardware?
The balance of risk there is precarious. Because if the end users of those AI data centers, the everyday businesses buying software subscriptions from OpenAI, generate enough tangible revenue to pay back the infrastructure cost, then NVIDIA's financing is a masterclass in vertical market acceleration.
But if that downstream revenue fails to materialize, NVIDIA has essentially vendor-financed a massive bubble. They would be left holding the bag on tens of billions of dollars of rapidly depreciating hardware.
We really have to view this explosion of capital through a historical lens, which is exactly what economists at the European Central Bank did this week. They issued a stark warning, explicitly comparing the current AI boom to the 19th century railway expansion or the rapid rise of electricity in the 1920s.
Their economic modeling suggests a pretty sobering reality. Even if AI fundamentally transforms global productivity over the long term, just as the railroads permanently changed commerce, the market is currently driven by over-optimistic exuberance.
Historical patterns dictate that a massive stock market correction is highly likely once the initial hype burns off. The speculative capital evaporates, leaving behind the actual slow-moving physical infrastructure to slowly integrate into the economy.
That physical integration is already starting to tackle real-world problems, though, rather than just software tasks. Like, the UK is currently running a £5 million trial partnering Google with national air traffic controllers.
They're deploying AI to predict weather patterns and alter commercial flight paths to eliminate contrails, the icy white clouds you see trailing behind planes. Scientists refer to them as sky graffiti, and they operate like a thermal blanket, trapping a significant amount of heat in the atmosphere.
The thermodynamics of contrails are fascinating, and the AI modeling suggests that by changing an aircraft's altitude by just a couple of thousand feet to avoid humid air pockets, they can drastically reduce aviation's climate warming impact.
And this requires a negligible increase in fuel burn, which demonstrates the transition of AI from a purely speculative software play into a highly effective tool for physical world logistics.
A parallel attempt to build everyday utility is playing out in the cryptocurrency space right now. The crypto exchange Kraken just launched a debit card aimed squarely at mainstream consumers.
It offers 2% cash back by seamlessly converting a user's crypto balances, or their stablecoins, which are digital assets hard pegged to a traditional currency like the US dollar, so they don't swing wildly in value into US dollars at the exact moment of checkout.
Kraken is attempting to bypass traditional banking fees and embed digital assets into normal grocery store runs. It is an effort to legitimize alternative capital by making it invisible to the merchant, smoothly bridging the gap between speculative digital wealth and everyday consumer needs.
Because the everyday consumer is desperately trying to find a win in all of this. In every tight, squeezed economy, capital behaves like water. When the main channel is blocked, it finds weird alternative avenues.
One of the brightest, strangest spots right now is the commodities market, specifically British wool. Over the last year, the price of British wool has surged 70%, hitting roughly $3.40, or about £2.54 per kilo.
The mechanics driving that spike are a classic supply and demand mismatch. During the pandemic, the sudden halt in manufacturing created a massive global stockpile of unused wool. Over the last 2 years, that backlog finally cleared.
Simultaneously, the overall flock of sheep in primary production hubs like the UK and New Zealand has actively shrunk. So we now have constrained supply hitting a sudden resurgence in global demand for natural fibers.
And the utility of that wool is expanding way beyond traditional apparel. It's being bought up aggressively for high-end knitwear, woven into durable carpets, and heavily processed into natural slug pellets for agriculture, utilizing the coarse fibers that would otherwise be discarded.
Hyperlocal victories are also emerging, where specific government policies actually manage to bypass the macroeconomic freeze. A homeowner in the UK utilized a local warm homes government grant to install solar panels, dropping his household electricity bill to an astonishing 2 pence a day.
And starting this coming April, disabled residents across England will be granted 24-hour free bus travel.
Expanding that bus pass removes a massive economic and social barrier. Previously, disabled travel passes were restricted during morning rush hours, which functionally prevented individuals from using them to commute to reliable jobs.
By fully subsidizing that transit at all hours, the government is injecting mobility back into a segment of the labor force, entirely bypassing the inflation and wage pressures that are currently paralyzing small businesses.
When we talk about where the massive pools of everyday consumer capital are actually moving, though, we have to look at the explosive rise of prediction markets. Because traditional asset classes, like buying a starter home, are entirely inaccessible for a huge portion of the population due to those 6.75% mortgages, that capital doesn't just disappear.
Right, it finds new places to speculate. A new prediction market called Novig launched earlier this month on August 4, and it saw $125 million in trading volume in its very first week.
Novik is primarily hosting sports event contracts, allowing users to trade binary yes or no propositions on specific outcomes. The sheer volume of capital they captured in 7 days proves a broader financial behavioral shift.
When the barriers to entry for traditional wealth generation are impossibly high, discretionary income flows rapidly toward high-velocity, easily accessible platforms that mimic financial trading but are tied to entertainment or gamified outcomes.
The friction of a high interest rate environment is forcing traditional physical businesses to hunker down and survive on scraps of efficiency. Meanwhile, AI infrastructure and alternative digital markets are operating in this detached universe of seemingly infinite capital, creating a deeply bifurcated economy.
The long-term behavioral impact on the consumer is the most fascinating variable here. If the traditional milestones of wealth building, specifically the 30-year mortgage, remain frozen at near 7%, the psychological shift will be profound. We are watching the potential for an entire generation to permanently abandon the concept of housing as their primary financial vehicle.
It makes you wonder if that two-lane highway is ever going to merge back together. If you are entirely locked out of the traditional economy, you might just redirect your capital away from physical assets and into gamified, instantaneous prediction markets. The big question is whether we are witnessing a temporary freeze or the permanent rewriting of how an entire generation builds wealth.